So if you become the person who educates people on money, and then you show them how to use insurance to save money on taxes, and you show them how to use insurance to create perpetual generational wealth for their families. Most people don't like life insurance. They don't want to talk about it. But what if life insurance were more than life insurance? What if life insurance were both income replacement insurance, whether you die or live? What if your family had it as a policy? I don't mean a life insurance policy, but a family policy that everybody in our family, our family trust buys a life insurance policy on everyone. And every time someone dies, the money from the life insurance policy goes into the family trust that all the family members are the beneficiaries of, and we take some of those life insurance proceeds and buy more life insurance on the people in the family. So as your family grows, your wealth grows.
What do you know how much those expenses are worth? Did you know that you could turn all of your expenses into cash income? That's right. And if you could actually leverage your expenses into a revenue stream, how quickly would you want to learn how? I mean, what if you had been compounding 3% earnings on all your expenses since you were 18, or even younger? How much money might you have today? What if your ability to start earning an average of 3% on every dollar you spend was right here, today? And what if the results could be an additional $50,000 or $100,000 per year in retirement income? If that has your attention, keep watching, and I'm going to show you how. You see, just one little change in how you choose to flow your money out of your hands and then to others is all it really takes to open up this additional income stream. One small change, huge results. Want to know exactly what that one small change is? I kind of thought you would. Okay, let's talk about your money. The money you work hard for, the long hours, maybe even multiple jobs. Money or that hard-earned business money. Yeah, that money that seems to go out as quickly as, you know what I'm talking about, right? So where's your money's first stop? Your bank, right? And they simply hold it, but they also loan it out, invest it, pass it around, and wait for other money to come back in so it's there when you need it. I mean, you know they don't have your money in a box or in the vault with your name on it just waiting for you to withdraw it, or for you to swipe your card and ask for it to go to the merchant, right? No, it just sits there on their bankrolls, their ledger, and they just account for it. And because people like us don't know any better, this hostage, we're just keeping track of how much they need to keep available, all the while they make lots of money with all of our money. Yeah, this game is starting to make a lot more sense now, isn't it? See, it's one of the biggest reasons we're not getting ahead. But don't worry, it all stops now with Stand Strong Capital. I'm going to teach you how to play the game to win. Now, let's talk about a typical banking flow of money. You work hard, and when you get paid, it goes straight to your bank. Let's call that bank your primary bank. So, what if you gave the primary bank a bump to the right and put your own personal Better Business Bank in first place? What if you own, let's just say, the Better Business Bank, and the expenses part of your revenue took a brief stop in your bank? Now, after a very short stay at the Better Business Bank, your money would then go on to your primary bank, so you could begin to distribute money to pay those expenses. Just one little change. But since your money was parked in your Better Business Bank first, you actually positioned yourself to make an average of 3% on all the money you move from your Better Business Bank back to the primary bank. And that's how you convert expenses into revenue. It's a tried and true banking strategy rooted in an arbitrage model. And I bet you're wondering just how it all works. Well, that's what I do. I show you how to use specific financial tools so that you can have your own personal bank. That means your car payment, rent or mortgage, food, your clothes, those really nice shoes, credit card payments, impulse shopping online, just bought some gas for your car, daycare, utilities, that stupid transmission repair, vacations, birthdays, education, medical expenses, student loan debt can all be positioned to earn revenue. Now, although I tried, I know I didn't list all the possible expenses. Just know that if it's an expense that you paid after your money went into your personal Better Business Bank first, you positioned yourself to earn revenue on that expense. That one small change makes a huge difference in how you cross the financial finish line. And the sooner you start earning money in your sleep, the sooner you reach those financial goals. We've all heard that wonderful piece of advice that says, you have to learn how to pay yourself first. But how many of you really knew how to until now? If this is all starting to make some sense,
Okay, so now we're going to talk about the banking aspect of it. And I'm going to share my screen. Y'all confirm when y'all can see my screen. Y'all see my screen?
Yeah, makes sense.
What screen do y'all see?
It say the new rules:
What did it say now?
tax-free, risk-free insurance
There
strategies.
we go. All right. All right, so let me move this monitor board out my way over here, and we will go ahead and get started. All right, so we covered all of that. Let's go right here. All right, so this is the crown jewel of the whole system, y'all. Okay? This piece, what I'm showing y'all, is pretty much the answer to everybody's issue when it comes to debt, especially those that are, understanding how banks really function and understanding the valuable consideration and, all those things with promissory notes and retail installment contracts. When you come into knowing about all this stuff, you feel betrayed and you feel upset and you want to take action, right? But we have to be strategic when we move because you are fighting against a very, very large machine that has been very successful at what it does. Now, with these policies, we're able to take the road of least resistance in a situation because we can take the situation that we feel is bad and turn it into a positive. And that's by just simply changing one thing, where we put our money at. Okay, before we go to pay any bills. The average person, when you get your money, it goes to some type of financial institution. Okay. With what we do when we incorporate this insurance policy to act as a better bank account, we're able to redirect funds. Okay. Then we incorporate a credit card to give us float time in between. What I mean by float time? Well, your credit card, you have a billing statement date and you have your statement end date. Okay. When you know these dates, you can manipulate them at times too so that they can work in your favor. But knowing those dates, you know when you can start putting charges on a credit card and how much time you have before those charges are going to be due. Okay, so we use that in conjunction with your policy when we first set it up so that you can have time to let your bank account or your bank build up money before you have to take out a loan against it. Okay. So that's where you get the 30-day float. And sometimes these cards, they give you points and stuff for using the card. So you can put the transactions on the card and then pay the card off before the statement due date. Then you don't have no fees to use the card. And you can also get the points just for moving your money over there. So that's what's so important about being able to have a credit card to float your expenses on throughout the month. Now, the process works like this. Month one, when you get paid, your money goes to your bank. It just sits there. That's the standard operation. Well, once you get your policy set up, once your money hits your bank, you're going to transfer it to your insurance policy. Okay. Boom. You see how the money goes over there. Now the clock starts because what the insurance company tells you is, hey, let us hold your money for at least 30 days and then you can borrow 80%. Okay, you can do a secure loan for 80%. And we say borrowed and secured loan, but you got to understand they're not giving you your money back. They're going to give you somebody else's money that they're already holding. Okay, your money's locked in their system and it's being tracked, and the compound interest is clocking on it. Okay, now with that compound interest, they're guaranteeing you at least to 3.5% on all your deposits. Okay. On every dollar you put in there. The bank, however, is not offering you these types of numbers, and we're so faithful to just to put our money over there. And the bank's not giving you no type of death benefit in the event that you pass away. But we're so faithful to the bank. Well, we have to change that mindset. Get off that bank and start getting on your own bank with your own policy that affects your own life. Okay. Now, while our money's sitting over here in our policy, like I said before, we're paying our bills on the credit card throughout the month. All right, for the next 28 days. That's how we get that float time in between the money coming in and when we need to go pay those bills. That's why some bills you can't put on a credit card, like some mortgages you can't pay with a credit card. So you have to have time to get you some float. You might not be able to do it in the beginning. You might have to work your way up to be able to pay your mortgage out of here. The whole point is, as long as your money hits this policy first, you good. Okay. Then 30 days later, for those that are employed, you get another check in, or you may get paid every, twice a month. However, when that next check comes in, it's the same thing. As soon as it hits your bank account, you let it move on over to that policy. Now, within that first 30 days, you're going to have two checks sitting off in there. One that's already been in there, and that fresh one. Now, you can ask for that loan out your policy, and what they're going to do is send it back to your bank account. Okay? Now, from your bank account, go pay your bills. Right? Or you can go pay that credit card off because it's time to pay. See how the money goes over there to the credit card? Boom, you paid it off before the due date, so you didn't get no taxes from the credit card. But if they had points or cash back, you gained all those types of rewards just for using their credit card. All right? So that's the extra perk of the credit card. And then the next thing you're going to do, same thing. It's just a cycle. You repeat the process every month for the rest of your life. What do y'all think about that?
Sounds like easy money to me. Sounds like easy money to me.
Pretty simple?
Yeah.
Okay. Now, that's the concept. All right. But y'all know me. I'm not going to tell you something without showing you what it actually looks like on paper or in real time. So now we're going to look at some information. Can y'all still see my screen? What screen y'all see?
Policy information.
All right, good deal. All right, so let's see which one we want to look. Let's look at my illustration. Okay. So this was illustrated to me almost 2 years ago. All right. These illustrations are cool because it gives you a visual, but you can't really rely on them because they're based on past performance. Okay. Past performance. What these illustrations do for us, they give us something to see visually so we can really put the concept together on how fast money can grow. Okay. Because a lot of times it's just hard to believe this, but I'm going to show y'all. And let me go ahead and maximize this full effect. All right. So this was quoted to me as 6,000 annual. How much is that a month?
$500.
$500 a month. Now, keep in mind, this is a policy we're using for banking. Okay? Banking. This is for banking. I'm using this for banking so that I can put deposits in here to capture compound interest before I go pay expenses. Okay? That's the whole intent, to put the money in and leverage it. Why? Because that's what banks do. You make deposits in the bank, they go and leverage your money. You don't leverage the money. They do, because you don't know how or where that you can leverage it and get a return. Well, we can not only get a return, we can also get life coverage and living benefits with our expenses, being able to place them here first. All right, so 6,000 annually is $500 a month. You say, hold on, let's do the number based on what you just said. I thought you was using this for banking and deposits and expenses, Brian. I am. It's just the way that it's structured, you have so much flexibility. You're not pigeonholed to one number. Okay. So check this out. So as we go, you see what that death benefit was. Now, this was based on November, October 2023. All right. Now we're going to scroll down here a little bit to some numbers right here. Okay. Now, there's two numbers I want you to look at. This guideline level premium, and then I want you to look at this max non-mech amount. Now I'm going to save you on what this means, but just in general, this is an IRS term because these policies are governed by the IRS, okay? This is one of two types of tools that people have access to that the IRS will allow it to grow tax free. Okay? Tax free. That IRS code section is section 7702A. If you see right above here where my mouse is, that's where the IRS regulates these types of policies. So when you see this non-MEC, that means this is the maximum amount that the IRS would allow me to put into this account before they classify it. It was called a modified endowment contract. If they classify it as a modified endowment contract, that means I could be subject to some type of taxation on this policy. Okay? As long as I stay under this amount, I'm good. Okay? Now, this will be considered my max amount. Now, you notice that document says 6,000 annually, right? 6,000 annually. What is 6,000 times 12?
72,000.
It's 72,000? Okay. So if I was to do 6,000 for 12 months, that would be too much, right? That's over 45,000, right? What is 36,000 divided by 12?
3.
Say it again.
3,000 and some change.
3,000. All right. So that means if this is my yearly amount that I can put in there, I can put at least 3,000 a month into my account, and that'll cover my guideline level premium. So that's 3,000 a month. Even though you seen that we just broke down that this policy said 5,000 a month, right? The 6,000 annual that we looking at right here, you see right here, initial premium is 6,000
it's
annual.
five.
Annual, that's one time a year. One time a year, it would be 6,000. I would be cool. I still have this coverage. Okay, that breaks down to $500 a month. All right, but what I'm showing y'all here is I have so much flexibility that I can actually put 36,000 into this policy within 1 year.
36,000.
Are y'all following me? Okay.
Yeah.
Now, if I'm getting really happy and have a really good year, my max is 45,000. So that's a lot of room. Where would all this extra money come from? Well, this policy was designed based on my expenses. See, the average agent is taught how to look for your disposable income, what you have left over after your expenses. So if they're looking for what's left after, how much money are they leaving on the table when it comes to designing you a policy to take care of you for the rest of your life? They're not looking at it for the rest of you. They're worried about your death. They're trying to sell your death insurance. It's only good when you die. Well, I'm showing you real life insurance that you get to use when you're alive, and you can still access the money. See, we pay for insurance on houses, we pay for insurance on cars, we pay for insurance on cell phones. Once we make those payments to those insurance policies we have, you don't get to go back and access the money. Those are true expenses. But with policies set up like this, you can put your money here first, then you go pay those expenses. And guess what? Now every dollar that you spend, you make compound interest for the rest of your life. Are you worried about bills?
Yeah, I see where you're going with it.
You're not worried about bills when you know where to put your money first because you know every dollar makes you a dollar. So what we say is every penny counts. You just got to know where to put the penny because one penny compounded for 30 days, doubled for 30 days,
Makes sense.
turns into $5.3 million, y'all. That's a penny. We're compounding dollars annually over our lives with this. You have to pay your expenses anyway. Why not make $1 off of it? Why not compound that dollar or put yourself in a position to be able to compound that dollar? The younger you start doing this, the better. Braylon, you're the youngest on the call. So you have the most to benefit from all of this. All right. All right. So this is my policy I'm showing y'all. So I want y'all to pay attention to those numbers because you're going to see where these numbers is going to really show something. All right. So basically what you're looking at right now, what I've just discovered with you, between 1 year, I can put at least $36,000 in my policy, and the max amount I can put in there is 45. The first year. Now, when the second year comes, guess what? I get a whole new amount. So that's another 36 minimum to 45,000 maximum. So between the 2 years, I will have how much? $90,000 that I can put in there. Every year it goes up 45,000, right? Because it's a new year of expenses. All right, now this is a very abstract way of looking at policies. I'm telling y'all, nobody talks about, nobody else can show you because they don't have this. All right, they don't even know how this stuff is structured. Now I'm finna go here and show you the graph. All right, so remember we was looking at the charts before on the other two policies, right? Those other two policies were structured for two separate things. One was your retirement, the other one was replacing your income. Well, this one's strictly designed for banking. All right, now you see this first year at the age of 41, this is 6,000 for the whole year. Okay? So if my goal was to put $500 a month into this policy, at the end of the year that would be $6,000. All right? At the end of the first year, you see how these numbers right here is low. Well, you put 6,000, they only gave you accumulated value of 1,000 or a cash surrender value of 1,000. Yes, indeed. Because the fees in the beginning of these policies are very high. There's no secret about it. But I'm not worried about fees because I'm worried about what this is going to do for me now, not when I'm dead. So let's pay attention. Notice for the first 10, 15, let's say, we'll stop it. Let's go for 10 years. After 10 years, I would have deposited $60,000 in this policy. Look at my accumulation value, y'all. 10,000. They say, oh, you lost about 50,000 right there. Look over here at cash surrender value. If I wanted to say, I don't want the policy no more, I want my money back, well, this is all they would give me. Say, wow, you lost a lot of money right there. Look at my death benefit. It went up by 10 grand, almost 10 grand. Well, this policy wasn't designed for this. This is just a byproduct if this is what I was going to use it for. We design these policies with what's called maximum funding. This isn't maximum funding. Okay? So since this isn't maximum funding, this illustration isn't accurate. My numbers would look better than this. But just for sake value, worst case scenario is what we show. We want to show the worst. That way anything better than the worst, we over deliver. Okay? We over deliver. All right? Now, as we keep going through there, I'm just showing y'all over time what this is doing. It doesn't look too good. Now, let me show you what it looks like in real life. So, here we go. Now, see the date right here, 11/13/2023. First premium payment was 6,000. Do y'all see that?
Yeah.
Yeah.
Okay, so that means that first premium payment, it was paid for the whole year, technically, right?
Right.
Yeah.
Right, but we're not using the policy for that. We're using this thing for banking. So you see, I maxed that whole thing out for the year. Boom. Now look at the date. I let it just sit in there for a couple months. Because see, my year starts in October or November of the following year. Okay? So watch me now. I made when I made the decision to set this up, I set it intentionally for the year of 2024, a 12-month run to see what it do in 12 months. Okay. So I went on and dumped that first 6 in there and let it sit and marinate. So by the time I need to start pulling money out, it will be ready. So what you see here, the end of January, the first loan was taken out. Boom. Couple days later, another payment is put in there, 3,000. So technically, that covered me for a whole 6 months. I'm up a whole year and a half. You see that just between those two payments? Y'all catching me on here?
Yeah.
All right, because
The
it's going to take
3,000
off.
represents the
This is me
3,000.
making a payment on the policy. Okay, me making payments on my policy. I'm using this policy for a bank, so I'm dumping large amounts in there because I'm going to be pulling amounts right back out. So boom, here you see I made a loan repayment February 15th. Okay, here goes some more payments. That's a loan payment. So I done put another 9 grand in there. Okay, then I took out 5 grand. Okay, then I made a payment of 15,000. Okay, they sent me 3,000 back because it was a communication hiccup. Then I took out another loan of 5 grand. I made another payment of 3 grand. Okay, this is just by what, June of 2024. So we're 6 months in. Took out another loan of 10 grand. Paid off a loan. Well, I'm sorry, I didn't pay off a loan. That's a payment. I paid a actual premium payment, so I put more money into the account at 9 grand. Okay, then I took out a loan for 6. Took out another loan for 5. Had a return payment for 3 grand. I took out a loan for 10. I repaid 3,000 of a loan. So do y'all see how these transactions are back and forth, just like you do in your bank account? Loan take it. Okay, here we go. Now check this out. Y'all see that? Return payment of 30,000, a return payment of 60,000. Now, what happened here is they was trying to pull money when I requested them to pull money, but they was pulling it from the wrong account. Okay? So now you see a return payment, you see the loan repayment of 30,000. So now I just dumped a large amount of cash back into loans that I was taking out. Because the beautiful thing about this, remember, whenever I put money in my insurance policy, I have access to it. So I can take money right back. I can put money right back in there. So it's back and forth, back and forth. But every dollar that goes in there, I'm accruing at least 3% interest on it. All right. So here go another premium payment of 3,000. Then they send me $20 credited in interest just that fast for me doing these little small minor transactions. Okay. Here go another loan taken. I took out a loan for 35,000. Okay. I could have went and bought a car with that money. Okay. Premium payment. Interest credited 0. Premium payment. Here we go. Me paying money back. 16,000, 3,000. Then we got to show another 0 interest credited for that section. Now let's go on to the top. Here we go. Now we're in this year, the beginning of this year. You see me making a payment of 6,000. I took out 2 loans within a matter of days, 9 grand. Then I made a payment back of 3 grand. Took out another loan of 5 grand. Then I made 2 more payments of 3 grand each. Then I took out a loan of 3 grand, and that was earlier this month. So do y'all see how constant this is? And y'all see that, right? Does that make sense? Y'all see how frequent I have access to my money?
Yeah.
Right. Now let's
I
look
got a
at
question.
Go for it.
So you initially started by paying a premium of $6,000 up front. So and you are making all these loans. So is this money coming from the face value of the policy?
No, the money's coming from the value that I put in, that I contribute. Okay. Now I'm finna show you right here. Here go the numbers so we can see it all visual. Because I just wanted to show you each part differently so that you can see you can see what it's set up for. You can see me making transactions, and then you can see what it looks like 12 months later. Okay, so I'm taking you down a path. So now we're going to look at the review of all those transactions. What did that do to my policy? Okay, because this is an insurance policy that we're talking about here, but you see me using it like a bank account. Now let's look. So right here, summary of insurance benefits. The face amount was 720,000. That's where we started. Okay. Now the death benefit shows on here at this point in time that it was 740,000. You say, wow, that thing went up $20,000. Well, hold on. It shows an accumulated value of $72,000. What does that mean? Well, in the last 15 months, my value overall in this policy went up $72,000. At the same time, I borrowed $52,000 against that $72,000. Look at the $72,000. It's really like $80,000 because that's how much I really deposited into this account between those 15 months. I put in about $80,000 minus fees associated with me being able to do this. Okay, me paying the insurance company and fees about $8,000 within this 15 months of me having access to 52,000 because that's what I've actually loaned out, and I still have another 20,000 that I have access to. But by me doing these transactions, in the event that something happens to me, my family would have got 740,000 just because I knew where to put my money at. Now I put technically 80,000 here. So do you think 80,000 is a good 740,000 is a good trade-off for 80,000?
Exactly.
Yeah, I see it.
Nobody can say different because I would ask you, where's your money now? It's not here. You're not getting nowhere near this right now in live time. So to have a better option, you would actually have to be doing it. You get what I'm saying? So unless somebody can show me something better than this doesn't involve no risk. You don't lose no money. It's not tied to the stock market. But do you see how powerful it is, y'all?
Yeah.
But then you like, if you do put in a certain amount, they're able to tax it though, right? I think I forget.
No. There's no tax. The money that goes in here is after tax money.
Mm-hmm.
You've already been taxed on your check when you get it, right?
Right.
So they can't tax it again. You didn't do nothing but put it over here.
Okay.
And then what accumulates inside here is tax free. There's no tax for whatever accumulates inside here. You can always, as long as you're borrowing it below what you put in, you won't be taxed on anything because you haven't profited. There's no taxes on loans. A lot of wealthy people will go run up a bunch of debt on real estate because the real estate will appraise for more than the debt. Does that make sense? The real estate is worth more than what they owe, so they'll take a loan out against the appraisal value, and they can make money or live off the loan. Therefore, they're not taxed off a loan. You can't get taxed from a loan. It's a loan. It's not considered income. You feel me? They want to tax you on your income based on a dollar amount, but they don't tax you on loans. So not only do they not tax you on loans, but inside this policy, the money's allowed to grow also tax-free. So you get to access it tax-free and it grows tax-free. Does that make sense?
Yes, sir.
Yeah.
Okay. So that's what you're seeing here. So after those, this is really supposed to be like my year end, but you see it says November 13th to February 2025. So just in that short amount of time, the accumulation of this policy went up $72,000 and I was able to go ahead and borrow. So what does that mean? That means my money's in two places. You see my money ran through this policy and $52,000 went somewhere else as well. Well, that 52,000 was bills and expenses. Because I made sure that all the money that came in to the policy first before I went and paid any bill of expense. just to monitor and seeing what it did to my policy. It increased my overall net worth. Now, keep in mind, this is only one policy that I'm showing y'all. It comes in pieces of three. So this would just be the banking concept. You still have your retirement income and you still have your replacement income, which is the term. Now, I have seen people use these in a situation where they can take that loan out of here and then take some of that money and they'll take some of that 52,000 and they'll put it in another policy. Did y'all catch that? So now you have paid two policies with the same dollar. Y'all not hearing me, man.
It's interesting.
Y'all not hearing
I heard
me. You are paying two policies with the same dollar, and these policies are for life. So let's look at this in a realistic content. You have people with multiple credit cards, right? I'm sure a lot of us on the phone have multiple credit cards. Your multiple credit cards don't guarantee you nothing for life, but you still use them with no benefit. So when you have something like this in place, can you see what you're doing now with the multiple credit cards and you have multiple policies? This is a whole nother level of financial freedom as well as a financial strategy. Nobody's listening to this but y'all. Why? Because the person that invented this whole system that I'm showing y'all is my mentor. And he's been doing this, he's been in the game for 40 years, but he's only been doing this for 12 years. Because new laws come into effect and policy structures change. Just like, older policies back in the day, they're not the same as we have right now. We have living benefits, meaning you actually get to use these policies while you are living versus the old stuff only comes into account when you're dead. So I can't stress this enough, y'all. This is the crown jewel of anything else possible pertaining to finances. You cannot do these types of numbers with nothing and get these type of results, y'all. Guaranteed with no risk. And this is just they print this stuff off and send it to you all the time because it's not a part of the stock market. This is based off the index. It's like you give the banks a whole lot, or the insurance company, let me say that. You give the insurance a whole lot of money. They take a portion of your money and they do options, stock options and calls and stuff like that. Okay? That's how they make all their profits so they can afford to guarantee you a 3% return. Because they know how to bid and they buy in such a large volume that it's really cheap for them. Remember, they're doing arbitrage. It's not costing them anything. We're giving them all, we're providing all the funds. I provided them $80,000 for them to go do some trading with and guarantee me at least 3%, but don't put my money in the stock. And they said, okay, we got you. As long as you keep giving us your money before you give it to your financial institution, we're going to be all right. All right, guys. Now, you have any questions on this? Now let's look at something real quick. Go ahead. I want y'all to look. We see my death benefit says shows 740 here. Let's go back to the illustration so we can see what 740 showed on the illustration. What does 740 show? After 5 years, it showed a death benefit of 740, y'all. Y'all see that?
Yeah.
Over here on the far right hand side.
Yeah, 742.
So I wasn't supposed to have a death benefit until 5 years from now. I did it in 15 months. So you see why I said the illustration is not accurate? It was only based on me doing this 6,000 a year. Well, I put over 60,000 in 12 months. See, this only accounts for 60. At 60,000, they said my death benefit would be 771. I didn't buy this worried about a death benefit, did I? No, I bought this worried about stuffing cash in there so I can get that 3% interest on every dollar. That's why it accumulated. I've exceeded 60,000. I told you I did about 80,000. Okay? So that's just the power of what you guys are witnessing right here. So that was good to get me in the door, but I far exceeded that. So now I can ball this up and throw it in the trash because I'm not on the charts no more. It's not accurate for me. When this is more accurate for me right now because this is real time. My death benefit is already at 740,000 in 12 months. So just imagine what it's going to be in the next 5 to 10 years, y'all. Compound interest. All right. Did you have a question, Brother Victor?
No, I was just going to say that when you first started the presentation, you showed us the picture of a bank and piggy bank and money
Uh-huh.
coming in. So basically, this policy is you're using this policy as a bank account. You pay your premium first, and then you use this policy as your bank account instead of this right here. So you're depositing your money into this policy as
Yeah.
opposed to your own personal bank.
Well, some of us, you have automatic draft, so it hits your
Right.
bank first here. That's why I'm showing the bank because this is more realistically. Your money's going straight to your bank first. It's just after
Okay.
it hits, you're gonna transfer it, just like you would do on your phone if you had a checking and a savings account. You'll
Yeah.
move money from your savings to your checking. It's the
Right.
same thing, but you don't use their savings. You have your own savings over here. Because what a lot of people don't know is the banks, they deposit heavily into insurance policies. Okay? Heavily into insurance policies. I mean, very heavily. And I'll see if I can actually show you the data on where they put it. How much I think it was Bank of America I got to think where it was. Somebody sent it to me in an email or something. They sent me the updated data, but I'll drop it in the group. But I'm gonna show you. You can see exactly where they do this. The same reason why I'm teaching it to y'all, so they can make money off your money and they can avoid taxation on the growth of the money. Okay, we know they ain't trying to pay taxes. So if you pay attention to what they do, you can learn from them and do it. They just know that they can go put their money with insurance companies. Remember, who backs the bank? An insurance company. You ever thought about that? Your bank accounts are guaranteed up to $250,000 an account with your average bank. And it's guaranteed by an insurance company. The insurance business model has been used for over 100 years. It works, y'all. It's called arbitrage. It works. Those that don't know where to place their money, you get them to give you their money so you can give it to the people that need it, and then you tell them you're going to pay them well below what you're going to make off of it. That way you can take the spread. Well, our spread is just 3 to 3.5% a year compounded annually. Remember, I showed you on the other drawings what the actual numbers was. It was high in the 14%, but we can't show consumers that because it's too high. We don't want to set the expectation high. We want to set it low. Okay. But yeah, Victor, this is what you see. It's just realistically, people money going to a bank first. So once that money hit, you'll just transfer it over to your insurance policy, and it's an app on your phone that you can do all of this from. Okay. It's an
Right.
app on your phone. Real quick and done deal. All right. Now, in the first year, we do everything by email, but after the first year on your phone, it'll have an option on there that becomes activated. After you've done it for a year, it become activated, then you can start doing everything strictly from your phone. But that first year, I hold your hand. We walk everything with you. We remind you to make your payments. We remind you to ask for your loans and everything. We walk through this process with you the first year. We hold your hand. Okay, so you're not out there by yourself. We have clients, we don't have customers because we with you the whole time. We're not just selling you something and telling you to go fend for yourself. Nope, that's not how this works. Okay, it's a lot of money on the line, so we got to make sure that you are being well taken care of as well as educated. That's the biggest thing about it, just educating you. Once you get it, it's no big deal. It's not hard. Anybody think this concept is hard? Say something now, please. Let me know. I think this is easier than trying to fight debt. What y'all think?
Yeah.
Yeah. Yeah.
So that's
This
a
is a
headache.
whole lot easier to try to fight that, y'all.
Yeah.
So, some people like fighting, when it gets exhausted after time and you realize how much value your time really is when you're wasted on fruitful things when you could be gaining from it. So, any questions about this, y'all? That was a good question, Victor. Then I could go back and reiterate for y'all.
So if you become the person who educates people on money, and then you show them how to use insurance to save money on taxes, and you show them how to use insurance to create perpetual generational wealth for their families. Most people don't like life insurance. They don't want to talk about it. But what if life insurance were more than life insurance? What if life insurance were both income replacement insurance, whether you die or live? What if your family had it as a policy? I don't mean a life insurance policy, but a family policy that everybody in our family, our family trust buys a life insurance policy on everyone. And every time someone dies, the money from the life insurance policy goes into the family trust that all the family members are the beneficiaries of. And we take some of those life insurance proceeds and buy more life insurance on the people in the family. So as your family grows, your wealth grows.